Good morning and welcome to the Kigo Thinkers Baraza on the banking service, specifically bank closures, causes and effects. This is our fourth Baraza, a method we adopted after COVID, and that's how Kigo Thinkers works lately. Kigo Thinkers is about sparring, thinking, providing thinking spaces. And Kigo Thinkers is a network of academics, practitioners of wide-ranging disciplines with the sole mission to spur thinking spaces in Uganda. At Kigo Thinkers, we are convinced that the basic ingredient of the exercise of genuine citizenship is one's active engagement in thinking for one's community. When people are influential in society, when people are influential in their own community, then they can make a better contribution. And that's the definition of an active citizen. So I'd like to invite our keynote speaker, Dr. Fred A.K. Muhumuza, PhD. I hadn't known that Dr. Fred A.K. has an A.K., but I guess when you become famous, you have even the middle names. He's a director, Economics Forum, Macquarie University Business School, and an economist that has given service over the years. So to kick this off, thank you very much. Over to you, Dr. Mung.
Thank you, Oscar, and good morning to all. As introduced, we were going to be talking about bank closures and what could be the causes, what could be the effects of those. For those of you who would be able to sneak in, the people will show you some of the insights. We shall discuss more from the Macquarie University Business School. We want to be able to engage in these discussions of an economic nature. One, we were saying that the reason sometimes banks get closed is because banks are not like the other traditional business institutions. Anybody who has done economics, there is what they call free entry and free exit. That's not so in the banking sector. You can't just wake up one morning and you enter into the banking space and start a bank. Neither can you just say, me, I've gone away. The central bank would say, wait a minute. Before you go away, I have to determine how you go. But sometimes they can actually send you away if you don't get in there. That's because of the importance of the banking sector to the rest of the economy. You can close your school somewhere, you can close your small shop, but not so in the banking sector. It has capacity to send ripples that can cripple the entire economy. It can happen within a week, it can happen within a month, it doesn't usually take years. And there are, of course, unique cases about the banking sector that we call systemic. Systemic is, let's say, like when we got COVID. When one person gets COVID, that COVID can easily spread out to the rest. So that's the nature of the banking sector, that when one bank has a problem, it is possible to infect all the others. So the central bank is always alert to say, who is the weakest link in this business? You need to deal with them, and there are many ways that we shall see how that can be done. So that means the banking sector is always closely monitored by the regulator. It is one of those institutions that people have asked, why does the governor chair his board? That's the banking sector we're talking about. And then they might also ask you, pick your directors. The central bank has to vet them and approve them and can fire them. Same thing with senior management. Things you will not find elsewhere. But in the banking sector, that's the trade of events. So there are those stringent regulations for a purpose. The governance and the senior management of every supervised financial institution, as the central bank calls them, must be of their interest, and they must happen with their approval. This is one of the areas where you sit your board meetings and the minutes are reviewed by the central bank, by every dot, to even say, how come this board member has not been participating? Who is he? Can he stay? Can he all go off? So there are those kinds of restrictions at the board level, because the supervision of the banking sector is very, very critical, because of the reasons we have given, that the banking sector is not just a simple affair. So why close a bank? really it is your bank. And it has happened to me. Greenland Bank was my bank, and as a young man, I went to the bank and it had been closed. Poor me, what was I supposed to do? Parent, how do you parent? Walk back home, how do you walk back home? Your bank is closed, you can't access your account. Let's move to that slide of why close a bank. When the regulator really determines that contrary to normal insolvency proceedings, closure is the best option for protecting one, financial stability, because as I've said, there is systemic risk that one person can infect all the others. Depositors, the people that banks keep our money for, sometimes close of the bank is for your safety. Your money would rather be in a closed bank than in a failed bank, or a bank that no longer exists and shareholders and managers have run away. But also minimizing recourse to public action. We have seen in the past, like when Greenland was closed, Cooperative Bank, the president said pay everybody their money. Now, that means the people who are running the banks and really failed the bank ended up tapping the public resources to compensate those whose monies were out there. So the central bank is always alert to make sure that doesn't happen. So insolvent banks cannot be rehabilitated. That's sometimes why the bank will be closed, or they cannot be sold to another bank. Then liquidation or effective resolution of that bank becomes the only option. And as we've said, minimization of disruption of customers and also prevention of the contagion effect, as we've said. If anybody has COVID, it doesn't matter whether you are the president, doctors will advise you isolate. Mr. Museveni has done that before. So what are these conditions for the closure of the bank? One is if the central bank determines, and this is really in the law, that there is a likelihood that a financial institution would not be able to meet the demands of its depositors or pay its obligations in a normal course of business. None of you wants to turn up at a bank counter and the bank is telling you there is no money. Now, if the central bank determines that that is the likelihood, then that bank has a problem and they will have to deal with it. Two, if the central bank determines that the financial institution has incurred or is likely to incur losses that will deplete or substantially all of its capital. That is again when the central bank will come in. And as you can see, some of these things are subjective because we are saying is likely, but they keep getting into the details of the bank to understand its creditors, its depositors, its shareholders, its management. The central bank does a lot of on-site supervision. So they don't just wake up and say this bank would be closed. You know, they have been monitoring and watching, and they have taken that decision from within their knowledge. But also the last one is that the bank is significantly undercapitalized, and you've heard that in one of the most latest closures of Mercantile Bank. It was to do with governance, it also had to do with capitalization, and we'll look into that. The process or the procedure for bank closure and eventual liquidation: if the bank is placed under receivership, the Bank of Uganda automatically by law becomes the receiver. It can find some other entity to do that process for it, but it automatically will be the one responsible for that. And the procedure mainly will be, how do we treat the shareholders? What are the respective responsibilities of the Bank of Uganda? And then the role and responsibilities of the liquidator. That process has to be followed on and worked out. And then the real liquidation is one first step: take initial control of the stock of the bank that has failed. Who are the depositors? Where are the monies that they have lent out? Who are the other people with interest in this bank? Maybe where it is renting, the landlord may want to be paid his dues. There are people who supply goods and services to that bank. Who are they? Do they have obligations that they haven't met? So the first process is to establish that. Who does the bank owe? And what does the bank have by way of its assets? So you verify those. You don't just establish them. Some things can be claims that are not there, but also you want to verify whether they are genuine and the amounts. And then you value the assets of the bank and sell them. Now, once the assets of the bank have been sold, the proceeds can now be used to deal with these people that the bank owed money. But of course, as you know, the Deposit Protection Fund will cover everybody automatically up to 10 million. Now the question comes, if you had 2 billion in that bank and you're only being covered for 10 million, somebody may say, is that fair? Well, we can say it is fair because you knew. The Deposit Protection Fund hasn't hidden how much it will cover. So it is up to you to always know that if this bank goes under, I'm only covered up to 10 million. Do I want to still be with this bank? Those are judgmental things for each individual to have. The other part is now, what are the implications of the closure? One, closure does not mean the bank's clients lose access to their banking services and that depositors and other creditors lose their investment. It doesn't mean that. As I've explained, you will eventually get your money. In the case of Greenland, I think I finally got my money 6 months later. Don't ask me how I survived. We have always lived by hunting and gathering and all friends and relatives and in-laws. So we survived, but also I was having some small job. You only need to wait for that monthly income to come through and you see how you settle yourself. Secondly, the deposit, as I've mentioned, Deposit Protection Fund will cover the 10 million. And I want to believe people have received those. And then for those more than the 10 million, as we've said, they have to wait for that longer process, identification of assets and the sale of assets. Now, the central bank has conveniently sometimes tackled this complicated task by closing a bank but automatically having behind the scenes negotiations. So a bank can be closed and you're simply told, for those of you who are banking with this particular bank, your accounts have been transferred to Bank X. So you can immediately go to that Bank X and begin your transaction. And if you don't like Bank X, you want like Bank Z, there are Gen Zs who may want their Bank Z, not X, you can transfer your account, but at least you have access to that with immediate effect. Those are some of the procedures, but there comes a time when that process is also not possible and the central bank will simply close it off. But of course, the shareholders are the most affected in the institution because they were responsible for possibly somehow on what transpired. So the options for liquidation or close after closure, one is that the whole bank may be sold to a qualified investor or merged with a sound bank to restructure and run it as a going concern. As I've mentioned, remember Crane Bank, most of the people just moved on to DFCU. Those are some of the improvements that will be out there. The liquidator may actually split the bank in two parts, sell off the good viable parts, and then liquidate the remaining parts. A bank can have some assets, and in economics we call them toxic assets. To you as a banker, you may think that is an asset because I lent somebody 200 million. That person should be able to pay me back. Now you, if you have your personal relations, that can be an asset that you can count on. But we can come and value and say, surely the person you lent to cannot pay you back easily. We cannot force a general in the military to pay back. You can't go and sell his house easily when there is an entire platoon that protects him. Now these ones, we usually call them the politically exposed persons. You lend them with caution. The advice is don't even lend to them. I've asked individuals, would you lend money to General Museveni? I will leave that with you. Because if you need to recover, where do you find him? How do you sell his cow, or his car, or his house? So as a bank manager, we will not tell you don't lend to him, but when you lend, please have your provisions. The guidance may be as soon as you lend, write off. It's not money you recover. But should you recover it, be pleasantly surprised. And the president has come back. But of course, his peers can lend to him. They know how they get their monies back. But those are the banking issues that an asset can be valuable to somebody, but when you subject it to the possibilities of recovering that money, it's not there. And then the central bank will say, provide capital to cover those monies you lent, which are possibly not going to be recovered. The liquidator may split the bank, as we've said, and sell off those remaining good parts, and the bad parts, which you may think are loans to, I don't know, people you cannot recover from, they may not be sold to anybody. Now, the central bank as a supervisor liquidator may pay off the secured depositors, as it happened through the Deposit Protection Fund, which is another constituency out there in the banking sector, and then deal off with whatever assets that may be left. So the recent event in Uganda is really Mercantile Bank, whose Tier 2 license was revoked and was placed under kind of liquidation. The reasons were given to us. One was corporate governance and the other one was failure to recapitalize. And the recapitalization, as I've said, it could be because you've been lending depositors funds and you're not getting it back into the bank. You are required as shareholders to put in money. If you fail to put in money and remains below the threshold that central bank recommends, they will have to wind it up. But also, as we know, recently, over the last 3 years, the central bank increased the bank capital. Tier 2 institutions are supposed to have up to 120 billion. Tier 3 institutions up to 150 billion. And they were given a period of 3 years to raise that money. And the deadline was 30th of June 2024. So on 1st of July, the central bank had to keep checking who doesn't and who does not. But of course, they have had a roadmap, so it wasn't to be surprised on that day. They were looking through who is progressing, because each bank provided a roadmap on how they will meet that by the deadline. And some who did not get there, they took the different options as we have discussed them. Either you merge or you downgrade yourself. You can't find 150, but you can find 120. You downgrade. You could even go to Tier 3, and banks have been doing that. What has caused some of these as I close? One is regulatory changes, as I've indicated. The requirement initially was 25 billion. Now you can imagine you are on 25 billion, you are running your bank. The central bank wakes up and says in 3 years you should be at 150 billion. Now some people can't jump over that big, long hurdle. You can either find another bank to merge or you can find new investors to come in and join you. But also the second part is really the economic situation. And we shall be discussing those as I come to the close. So one is on the changes in the regulations. As we have indicated, there were those requirements and some banks preferred to downgrade. I don't want to mention names of banks here. My colleague there is better versed to do that. For many reasons, really. He's here, he will give us that. He knows better or what needs to be said. I'm also somewhere in a corner embedded in the same banking sector. So I don't want to speak about other banks and what has gone on with them. So as well as raising the minimum capital requirement, the central bank also increased the minimum, what we call cash reserve requirement, from 8 to 10%, and that can keep moving. I think now it has also moved beyond the 10%. What is this? That of the depositors' money, don't lend all of it. 10% of it must be kept within the bank as a liquid asset. In the case of anything, a bank must be liquid. What makes a bank is liquidity. As I've said, you don't want to wake up, go to your till, or go to the ATM, and there's no money, and you have an emergency to handle. The central bank makes sure that money will always be there. So those are some of the conditions. But remember, if you can't lend 10 or 12% of the depositors' money, then you are crippled in a way you may not be able to get money out of loans to continue running your bank business. So the options that were available, people merged, and certain banks, others sold themselves, others did the downgrading, as we have talked about. But there's also one challenge in the banking sector in Uganda, is what we call concentration. There might be 25, 26 banks, but really 5 top banks control more than 50% of the market share. And when you increase those to 10, you go all the way up to almost over 80% of the market share. That means there are very many small banks. Baganda would say a lamb that eats among the cows. So it's like a small animal, but it goes in along there. Sometimes birds are sitting on buffaloes. You are moving in there, but really you might find stress and strain to manage in that space when your market share is that small. And the decision is really yours. The central bank would provide guidelines. You may decide to opt out, or if you stay in and you have your big feet, you can remain in there. So there are those issues of market concentration. Let's move on to that slide of market concentration. There is a slide that was done by young people at Sigma. No, previous one. Let's move to previous ones. There is an earlier slide. Move back. Yes, that one. So you can see that so many banks really disappear. We start mathematically, we talk of asymptotes. To the left, you have those big banks that will have a big share, almost 8% of the market, and then by the time you get to the extreme end of the right, the bank shares have gone down. That concentration in economics really is not good for certain small actors, because remember, if I come to withdraw money and you may have lent it and the borrowers haven't brought it back, the shareholders have not capitalized the bank, it creates a problem of trust. You don't want to walk to your bank and they're telling you there is no money. Banking sell trust as their main service. I always ask people, when you leave your money in the bank, do you know those fellows? Are they your relatives? Actually, you have run off from your relatives to keep your money in the bank, because your relatives are very dangerous when it comes to trust. But you're also trusting a banker who you don't even know. So the central bank must make sure nothing erodes trust. That anytime you walk into the bank, whatever you wanted to do is given to you, then the trust continues. So let's move on. Besides that, which are regulatory issues, the other one are the economic effects. Why the economy? Remember, the value of an asset, which is the loan a business borrowed, is embedded in whether this business is doing well. If I lend money to any of the media houses here, and that media house fails to find business, that media house will begin to struggle. It may fail to pay back the loan. And may be struggling, one, because of internal weaknesses, but it could also be the nature of the business. People are no longer advertising. That is usually your main source of funds. So what do you do? So the state of the economy, whether the economy is doing well and people are advertising, empowers the loans to become valuable. So there are issues that arise out of the economy. If that is not happening and people are not paying back, then banks face liquidity challenges. And reviewing the information from the central bank, it is true that a number of banks have been facing liquidity challenges, as shown by the number of banks that have gone to the standby lending facility, which has increased to 26 trillion over the last 3 months to May 2024, up from 19 trillion. That means many banks have been going to that facility to replenish their liquidity. But also some banks can borrow from each other. And you can borrow today and pay back tomorrow, which we call overnight. But the rate and the cost of borrowing for a night has been going up. One, it means there is big demand, but also it might mean a big cost to the smaller banks, which may not have some sufficient liquidity to run all their shows, and they are the ones that need to do overnight borrowing, or even 7-day, which is a weekly borrowing. The moment you see those rates going up, then those banks are going to struggle. Just imagine you go and borrow 1 billion from a bank and the interest rate is 10%. After 1 week, you should bring back my 1 billion from plus 100 million. What did you do? If it is overnight and it's 8%, you must bring back my 1 billion tomorrow plus 80 million. What did you do with it? So you begin to see those struggles, and the central bank increased the capital requirement to allow banks to be a little bit more stable with their own resources that they have. So the quality of those assets, I've indicated, has not been very, very strong for quite a number of banks. We have seen some trying to sell the assets of those who borrowed from them. But now quite often banks, to avoid all that, they may get into what we call self-screening. You restrict credit. You don't lend to some individuals. And we have seen evidence of that over the last first half of this year, there have been a lot of reduction in the lending, and that's the slide we want to have, the next one with the charts. That one there. You can see most of the bars as you move towards the right have been going down. The blue, which is basically lending to agriculture, was up there, but the last bar is shorter than the previous one. The purple ones have been going down. That is lending to manufacturing. It has been going down. The red is lending to trade. The green is lending to transport and communication. Yellow is housing. That one was a bit growing up, because banks will lend to somebody who brings in a good title. You know, I can recover that money. And then, as you can see, the business, the green, towards the end, even had negative credit in one of the quarters. So that decline is really banks restricting lending, because they feel the economic environment is not that very good for them to easily lend their money to take it out there. Next slide. You're looking at that tight monetary conditions. They are sometimes due to the monetary policy. The central bank has been tightening by increasing the central bank rate or keeping it high, which makes it costly for people to borrow, and also for banks not to lend because they feel the cost of mobilizing money is high. If I lend it at higher rates, people may not pay back. But also the government borrowing from the same system has crowded out a little bit of the private sector borrowing. Now the next slide, I hope it will, yes, it comes out well. This is really who is the manager of the business. We always say the business is not yours. The customer is the king. You don't set up Golden Tulip as a hotel and you say, this is my hotel. It belongs to me and you who are here. We are taking the tea, we are renting, we are doing things. That's the business. But most Ugandans don't know that the business depends on the households who actually do the final consumption. So you can see those yellow bars at the top. That is household final consumption expenditure. That is really the economy. The households in this country are the ones that run the economy by what they consume. Even when we support industries to set up, you are targeting those households. If those households are poor and they are weak and they are not buying as much, the businesses are going to suffer. And as we've said, the banks will also suffer if they lend to such a business, because me and you have not gone to buy whatever we buy. Rent, people will not pay, so they will vacate the buildings. So at bottom line, Uganda's policies need to come back and say, how do we make sure effectively households are able to generate money and consume and drive this economy? That's the global template you want to be looking at, and the main message out of this, the state of the economy can actually affect the banks. You'll see in the developed world, they will even pay unemployment benefits. It's not that they like these Gen Zs who are moving around and no, but the moment you give them money in the morning, they are going to buy data, they are going to pay their rent, they are going to move around, they are going to buy some clothes, drink a beer, then the businesses that supply those services will thrive. That's why the economy is. So economics can sometimes be funny, that you want an own goal, create confusion in the box. The other guys will score themselves. So you actually do it that way. You don't target the very person that produces the good, you target the one that buys from them. So we need to get back and say, how are we supporting the households? But look at those bars looking down, the brown ones. If Ugandans can't produce, foreigners will bring the items. If Muhumza needs shoes, buy Uganda, build Uganda doesn't sound for me. I don't mind who made the shoe. I don't mind who made the phone. Me, I need a shirt, I need a towel, I need something. So I will buy it from a foreigner. And that's what seems to be happening, because when you look through, and you can move to the next slide, the imports have been increasing. Meaning the things we need to buy. Look at that red line closer to the bottom, which is the difference between the exports and imports. It's negative, meaning we are importing more than we are exporting. But that negative has moved from 6% of the size of the economy 9 years ago to actually 10%. So we are continuously importing more. The other red line at the top is government consumption. Government is not really the one that drives the economy. It facilitates. That should be its role. But when you see government size of the economy increasing from 7 to 9 or almost 10%, you get concerned, because it's actually taking in resources, and as we know, government does not produce goods and services. Even when it does, it doesn't do an efficient job. So there is a third red line from the top, which is what we call the gross fixed capital formation. These are investments by the private sector. And we see those have become smaller, from 24.8, almost 25, down to 22.7 over those 9 years of the analysis. So investments by the private sector in Uganda have gone down. But remember, Ugandans are still buying. So who are we feeding from if it is not Ugandan businesses? And how do we resolve that? Next slide. And there are 2 more slides, then I'll be quiet. I made this line specifically red. That is Tanzania. You can see our imports from Tanzania. They went down. There is a flat like a valley. That is COVID period. But soon after that, Tanzania has gone up so fast. So Tanzania, people are investing. I even have evidence Ugandan manufacturers have relocated to Tanzania to come back and sell to Uganda. Why causes that? These are issues we need to address, because that means banks in Uganda are going to struggle to find a viable borrower from them. If the viable borrowers are shifting to Tanzania, if Ugandans are borrowing to buy from Tanzania, we are creating jobs in Tanzania, we are supporting Tanzania, and you can see the red line has by the way caught up with that. Top line is China. We are importing as much from Tanzania as we are importing from China, the second largest economy in the world. What is happening there? You need to address that, because that will send ripples to the banking sector in terms of the economic situation that they are operating in. Kenya has actually gone down, is the dotted red line. So those are issues. So why are Ugandans not investing? We get to the last slide. Remember, I've said government consumption has been increasing. And how is government increasing its consumption? Imports from Tanzania are not taxed. This is a member EFC. The bulk of them, no taxes. So until you cut down your spending as government to compensate for that loss in revenue, URA can't find that. It doesn't matter who you send in. What was the name of the young man? Karekes? He would join John Musinguzi, but they can't tax Tanzanian goods, simply because EAC arrangements. So with that loss of revenue, government has got to either scale down itself. We have been talking about rationalization to fix government and make it smaller and leaner. Parliament spends almost 3 billion per day. How do we reduce that? Now, if you don't do that, you're going to end up borrowing more, including borrowing to pay debt. So that line you see, that table you see there, it's indicating to us that the first 11 months of last financial year, July 2023 to May 2024, we borrowed up to about 14 trillion shillings, of which 8.4 went into debt service. So literally it did not speak to facilitating investors, it did not get into enabling households to produce and be able to do what they need to do best. Only about 5.7 trillion was available for services, and mainly it was go to wages. These are underlying issues that might actually speak to the bank closure. The state of the economy is directly speaking to whether the loans are viable, whether the businesses are viable, and if they are not, then the banks are going to struggle and the central bank will have to respond as it has responded. Thank you very much for your kind attention.
Thank you so much, Dr. Fred Muhumuza. I've had a review already coming to me saying Dr. Muhumuza simplifies banking so well. He's a proper Musomesa. But I wanted him to talk about me, who has 12 million in Mercantile Bank. So maybe we'll get him up here soon to talk about that person. We'd now like to invite Dr. Kenneth Egesa, Director Communication of Bank of Uganda, to give some responses and some comments on the topic. It is pleasing that Bank of Uganda has a commitment to send Dr. Egesa to respond to issues. And he has a tougher job than Dr. Muhumuza, because they are the ones who know the health of a bank. You seated out there, you do not know the health of your bank. Okay? How would you get to know the health of your bank if Bank of Uganda has not told you? And if Bank of Uganda turns up and closes your bank, you have lost out some money. The good thing is, he confirms that the ones of Mercantile Bank, and there was another one earlier, they've received the 10 million and below, but those above 10 million have not received and have no communication. So should we have more trust in banking? Dr. Egesa, over to you.
Thank you very much, Oscar, for the introduction and the parting shot of your introduction. Thank you, Fred, for sharing your insights. I think let me start with the last point Oscar mentioned. We've had 2 bank closures in the recent past. That is EFC
EFC is, thank you. EFC was an MDI, microfinance deposit taking institution, although we usually call them, all of them, banks. And all the depositors of EFC have received their funds. The most recent one is Mercantile Credit Bank, which is a credit institution. And the depositors who had 10 million shillings and below have received their payments, except those who didn't respond to the DPF to provide the information required. And follow-up is ongoing, so they will all get paid. But the majority who had 10 million or less have been paid. Now, what about those that had more than 10 million? I think I should clarify this before I go into the presentation. Those who had more than 10 million shillings have received up to 10 million as the law requires by the Deposit Protection Fund. That difference is to be paid by Bank of Uganda. However, there is a process to raising the funds to pay these deposits that exceed 10 million, which we call the uninsured deposits. And that process involves liquidating assets that Mercantile Credit Bank had, because remember, when you're closing the bank, it means that it has issues with funds. So we have to raise the funds by selling off the assets. We have to raise the funds by collecting on outstanding loans. And if you have been reading the news, you must have seen our notice to the public asking borrowers to service their payments. We must raise those funds by drawing down on any deposits Mercantile Credit Bank had with other banks. If they had bonds and treasury bills, we have to sell those and collect this money. Once this money has been collected, this is what will be distributed to all of the creditors of Mercantile Credit Bank, including the depositors who had a portion of their deposits uninsured. So we will be communicating on this process. Right now we've raised substantial funds, but remember, we have to distribute to everybody. So we don't want to start distributing to some because of the pressure that's coming, and then you find that what's left is not enough for the rest. So we will communicate and inform. Now let me go to the substance of the day and just make a few comments on the presentation. I must say that Dr. Muhumza actually made me feel like I was back in school just following through his presentation. It was very methodical. So let me start by saying, picking from what he said, the banking sector is in the business of selling trust. It's not in the business of taking deposits. It's not in the business of giving loans. It is in the business of selling trust. And I'll explain a bit more. Why trust? Like Dr. Muhumza said, when you take your money to the bank, why do you choose a specific bank? And why do you take that money there? Because you have the trust that tomorrow if you come for that money, you will get it. Okay? So that then explains why we can't have free entry and free exit in the banking sector. We have to make sure that whoever is coming into the banking sector will, one, play by the rules, and two, will uphold the trust that we are selling. And also that explains why there is no free exit. We have to make sure that the exit of a financial institution does not undermine the trust, especially for the depositors. That's why when a bank has issues and we have taken all actions to try and save that bank and we fail, we have to close it. Why? If we close it ourselves, we will limit two things. One, you've heard of bank runs. If the customers start feeling that this bank has issues and the central bank delays, overnight people can go and withdraw all their money. And what does that mean for those that haven't withdrawn or haven't been there on the day the withdrawals are happening? They'll lose their money, okay? Also, we can have what we call asset stripping. The shareholders or the managers of the institution, if they know that the bank is going to go down, can remove some assets or can cause the value of the assets to go bad. All those things impact mainly the depositor, who we must protect. So that's why you will find that the central bank will be the one to tell you that this institution, we have closed it for these reasons, and this is the process that we are going to take to make sure that the depositors get their money. So I thought that I should talk about that, which is very important. Now, bank closures. Why do we close banks? First and foremost, closing a bank is the last option on our deck of cards. Usually, we will tell, because we do regular supervision. We do both on-site and off-site assessment. On-site means you go into the bank and ask for all the records you want and discuss with the managers to get certain details about the health of the bank. Off-site, we get reports. Some reports are weekly, monthly, quarterly, and we analyze these reports. So, in the bank, in Bank of Uganda. So, off-site can trigger an on-site interrogation and vice versa. Now, most of the reasons, the main reasons for bank closures are either the bank is not profitable and has not been profitable for an extended period. So that tells you that this institution is not able to run sustainably. So that can be a cause. The second one is liquidity. Remember, we said we are about selling trust. You want to go to a bank, and if you want to get your money, you should be able to get it. So if the bank has issues with the liquidity, that's when you have problems of you go into the bank and they tell you wait for 2 hours before we give you your money. So that also can be a concern. The second one is asset quality. And asset quality, here we are looking at the assets of banks. The main assets of banks will be the loans they extend. If a bank has poor risk management that impacts their credit, meaning that out of 100 loans they give, they can't recover a large chunk of those loans, that causes the bank's asset quality to deteriorate. We usually use things like non-performing loans, share to total loans. So if a specific bank has a high share of non-performing loans to total loans, and this is increasing and running over a period of time, that's also a sign that there is a problem with this bank. And of course, what does that do? It feeds through into capital. So once a bank has non-performing loans, we ask them to provision for those loans by either bringing in more capital or finding other ways to make sure that the resources available should be able to ensure that the bank runs as a going concern. So those are some of the reasons. Now, what do we do as BOU? Most of you will probably think that the moment we see these problems, we close the bank. We don't close the bank. We do what we call prompt corrective actions, and these can vary. We start with fairly simple corrective actions, but then these are increased in severity over time depending on how problematic the bank is. So what are some of these measures? Number one, we may ask the bank not to pay dividends to its shareholders so that funds are reinvested into the institution. We may also ask the bank to change its management and even its directors on the board, because maybe we may have seen that there is a governance issue. I think you have heard some of the reasons that have caused the closure of EFC and Mercantile Credit Bank was poor governance. So we may ask a change in the directors to address this situation as opposed to closing. We may also ask them to stop expanding. We may ask them not to pay bonuses. We may ask them to go slow on staff recruitment. All these things are intended to conserve resources so that the bank is able to get back on the right track. Sometimes if these are not working, then we may ask for what we call a bail-in. A bail-in is when you ask the shareholders to bring in more money. And for each of these, we give the bank time. We will say, okay, do this action within the next 1 month. We count. After 30 days, if that action has not been taken, we escalate. Because you've not done this, we expect you to do this in the next 2 months, and so on. So usually bail-in is at the end. If the shareholders are given time to bring in money, and they bring in money, then plus all these other actions, then the bank will continue working as a going concern. If they don't do that, then now we go on to the final stage, which is liquidation. Now, liquidation can take many forms. It could be either, like Dr. Mhomza said, you look for someone to buy the good book, the toxic book, you find a way of making sure that you don't pass it on to somebody to cause a problem for the person buying, or you close the bank, pay the depositors who are insured, and then deal with the other uninsured depositors, or you get somebody to merge with that bank. So there are many options, but also depends on the issues that are causing that bank to go down. Sometimes some of those options might not be available. For instance, it might not be possible for someone to buy the bank either because it is in a very bad situation that they don't want to take on that risk, or maybe its business model doesn't work for many of the buyers. Okay? So I just wanted to emphasize that liquidation is at the last end. Selling the bank is the last option we take as BOU, because of course we want to maintain trust, and every time you close a bank, you hit on that trust. Okay, the other thing that I want to talk about is some of the broader causes for the closures. So the causes that I've discussed are the causes at the micro level, at the bank level. But there could be also causes at the macro level, which Dr. Mhomza has talked about. He mentioned regulatory environment, economic situation, and concentration risk. Regulatory environment should not be a cause for closure, and I'll tell you why. We increased minimum capital for banks, which are tier 1, from 25 billion to 150 billion. Yes, it's a very big increase. But there is a justification.
In a short time.
Sorry?
In a short time.
Okay. There is a justification. Number one, banks have been having minimum capital of 25 billion for more than 10 years. A lot has changed in 10 years. Okay? Second is, we don't say raise this money immediately. We give them 2 years to do this increase, and we give benchmarks. Okay? For credit institutions, it was from 1 billion to 25 billion. Again, the same process was given, and the justification is there. So just to say that, yeah, economic situation counts, but regulatory environment shouldn't count, because they have options. Those who can't raise the money can downgrade. They don't have to be closed, and or else they have time and various options. They can share, they can list shares on the stock exchange, they can get partners, and so on. So I'll stop there and then hopefully take on the rest through questions. Thank you very much.
Dr. Ken Egesa surely deserves a hand clap because his part was trickier. We will stop for a break and some water, maybe in at the 10 minutes mark at 11 a.m. I have noticed we have in the audience Mr. Ronnie Mutebi, who's a former banker turned into an auditor, and I'd like to ask him specific questions from the talk we've had. The first one is on consumer protection, because where he, as an auditor now, he should be looking out. So because these are media people and the majority of them have more than 20 million in their bank accounts, okay? You see how they are smiling. So what indicators are there for them to identify a potential problem? And in your opinion, Mr. Mutebi, do you think there are adequate measures in place to protect depositors? Two questions directly to you. I don't know if you want to take them from there or come up to the podium as well. Might be best to come up to the podium. Indicators, what would you look for to identify a potential problem? And is there adequate measure to protect these people with more than 20 million in the bank?
I'll start with the last one, whether there are adequate measures to protect the people with more than 10 million. Clearly, it may appear that the same procedure that is trying to protect the depositor turns out to be counterproductive if the same depositor has to wait for the central bank to liquidate assets, to recover loans. The question is, who pays for the time the depositor has to wait when they're out of money? It may appear that that same system does not cater for that time that I'm out of my money until the central bank is able to address. So the central bank needs to again relook at their mandate, because if on a daily basis they are looking at the capital of the bank, the quality of the assets, the liquidity, as you've said, the quality of management, they are able to see the trend. But what they are not able to do is to indicate to the depositor that, please do A, B, C, D. So for that period, I feel that the central bank has work to do. The other question was about consumer protection. It's clear that the depositors need to be sensitized more on where they can run to. What is it that they must know in the banking game? And that takes me to my question to the doctor. I don't know if it's because the banking sector continues to be one of the most profitable sectors, in spite of the fact that we show some statistics that the economy is not doing very well. People are migrating investments to nearby countries, but we still see the banking sector very profitable. I think, if I'm not mistaken, between the return is about 15% or 20%. Where does that profit come from? Thank you very much.
Good question to you. At the break, we will post a link to the COSASE report on bank closures of 2021. And I'll go back to Dr. Gesa and ask him if it was wrong to close Crane Bank and wrong to close Mercantile Bank. excuse me, considering the reports that were given at the time. So in the few minutes we have left, maybe Dr. Muhumuza, think about organizations like SACCOs, like for example, if you have a SACCO like Wazalendo, then if you have, I won't call NSSF a SACCO, but are we all in NSSF? Because, did someone say no? Because if you're in NSSF, that means you also have money in Mercantile, or but Crane was paid off. So what happened? What about unit trusts and so on? And NSSF would probably have a lot more money than the 10 million. Dr. Mumza.
Well, maybe it's effectively a question of relativity. NSSF may have billions there, but they have other recourse because they receive billions every day or every month.
So it's okay to lose these billions?
Not lose them, they can accommodate the delay he's talking about.
Yes.
Because sometimes the challenge with NSSF is actually liquidity. Where do I put my money? Which is not my case and your case. Especially as he has indicated, if this was your bank and every day that's where you go to pay off your normal business duties. So you're not only going to do the 10 million, but you pay your service providers, you pay umeme, you pay rent, you pay your laborers using that bank account. Now that bank account is not there. Literally your business will be stalled and annihilated. By the time you get back your money, and that process that Director Gesa has displayed to us, you may not recover all the money. As I said, some of the assets may be not recoverable at all. So it is even possible that you sell the bank assets and what the bank owes to its stakeholders is more than what you have realized. And eventually somebody will make a loss out there. But those are the hardships and hazards of some of these institutions. And that's why, as we said, the Bank of Uganda requires, strictly by law and its own procedures, that every bank must have an external auditor who has been approved by the central bank, and the external audit report must be published. And if you have noticed, throughout the month of April, banks are publishing their audit statements. Now, unfortunately, we haven't been told why that is so. Many people want to know. They won't even bother the papers to check how did my bank perform, because you can actually see a trend there and begin to say, wait a minute, this bank was making those profits, and those profits, where are now the profits going? What are its assets? They put all that information there for public consumption to use. And this is why Kigo Thinkers needs to be credited, that we are now here to tell people during the entire month of April, please pick those papers over the years and check what is the health of your bank. Where are the banks making their profits from? Most of this, as I've shown in that last slide, a lot of this money is coming from government borrowing. Because remember, when I lend to government, I don't even have to ask for a title. I don't have to chase. It's a sovereign. The government will pay, and pay is on the dot. So if the government 10-year or 15-year bond or 20-year bond is 16%, and as a bank I commit 100 billion to government, at the end of the year this government is going to give me 16 billion as profit. Now that is even taxed at 10% if it is more than 10 years. Yet if you run a corporation like Tulip, where we are, they will be taxed at 30%. And that's how I was saying, the signal in the economy is telling people, don't invest in production of shoes, of onions, and carrots. You'd rather put your money with government, go on the golf course, and wait for your money in your bank account. But remember, people still want onions to eat. They still want shoes. They still want textbooks. They still want pens and notebooks. So Tanzania will bring them in.
And work.
And make that money. So the signal we are giving is systemically, continuously undermining the very same space where the banks themselves are sitting. And as I said, whatever they are reducing, which we saw in the numbers, whatever they are reducing as lending to the private sector, they are increasing their lending to government. Now you have to ask Mr. Government, what are you doing with this money? As I indicated, 60% of it is going back to service the debt. So it's not helping us. So it can't come to the roads. Now how do you get out of that situation? is not going to be, well, the sun will resolve it. No, the sun will keep rising and setting. Resolution of this is going to take people sitting down to see how do we deal with government spending and where it is spending. So the situation is more than what the central bank can do. The situation requires restructuring and rethinking of the entire government, and I don't see those conversations happening.
Thank you very much. Let's stop for the break. We'll stop for 2 minutes and then kickstart the conversations again. But just a quick answer. Does the central bank have responsibility to advise the bank, for example, the economy, to advise government on the government taking loans?
It is the advisor to government. Now, whether the government is also part of government, some people would say, but it has its independence, but it's the advisor to government. And I think it does that. The rest is political economy spaces.
Thank you. We stop for a break. This is Baraza, Kigo Thinkers Baraza on bank closures, on the banking services, bank closures, causes and effects. We've had presentations from Dr. Fred Muhumuza, who actually took us to economics class on banking, as well as causes and effects of closures. Then we've had responses and some more learning from Dr. Ken Egesa. And now we are into the second part. We had one of the people in the audience, Mr. Mtevi, also posed the question and gave information. We also have a former banker here who is actually a former banker and regulator with Bank of Uganda, who in his retirement went to Chinatown and most likely suffering from the regulations that he imposed at the time, now when he joined us. So, to you, welcome Mr. Philip Katamba. Thinking about impact on community, how have bank closures affected the Ugandan community to begin with? If you think of the media house that I work for, it has over 100 employees. So, a bank closure, how would it affect such a community to begin with?
Thank you very much, Moderator Oscar.
The problem is when he comes up here, he's on a platform. You can sit down and face them, yes.
I can sit down.
Or you could sit down.
Thank you very much, Oscar, for the question. I'll just take it from a practical point of view, because these days I don't do much of the theory in the economics. I'll pick it from one of the questions which you asked about or commented about the NSSF, who are holding a lot of money, and the thresholds of those who are above 10 million. And I believe, and I start thinking, why over 10 million? The policy, maybe when it was being formulated, it was probably assumed that if somebody has maybe more than 10 million in the bank, he has to be very frugal and prudent, that he has to periodically assess his risk appetite. And I think also the underlying assumption, I may be right or wrong, the underlying assumption here may be that he has access to information and he can do the risk analysis. But from a practical point of view, is that the case? Is the regulatory framework consistent with the practices and what we have on the ground? My straight answer would be a no. Because, as you correctly put it, if NSSF never had his money locked up, say in a crane, its operation will still continue because he will get new money coming in, especially around this time since we have just ended the month, new money coming in every day, and then he has other options. But also we assume that NSSF will have very competent risk managers who will look at the market and also gather information, and then critically look at all those information which are regularly published at the end of the year. Even they will go and look at the provisions and even the maybe the daily reports and all that. So for us in Chinatown, we don't have that capacity. So we will depend on the decisions which have been made by the policymakers or the bankers, and whether they are doing inside dealing. It may be very not very possible for us to determine, and if the money is lost, and whatever is also being said, that there is a process which as a regulator has to go through before that. That information is privileged to very, very few policy makers, if not highly guarded, and so you never get to know some of this information, however much you may have the risk analysis skills. For now, I can stop there.
Thank you very much. And I don't know who's going to answer. Maybe Dr. Egesa will go first. My question earlier was Bank of Uganda wrong regarding Crane Bank? Was Bank of Uganda wrong regarding Mercantile Bank? Shall we get information later on that Bank of Uganda was wrong? There are two premises for asking this question, Dr. Egesa. The first one is Crane Bank seems to be winning cases in courts. I would dare say most of the time, I don't know. And the Kosase report of 2021 did indicate in many areas where Bank of Uganda was wrong.
That's a very loaded question.
It's Bank of Uganda.
Let me start by saying I cannot comment on individual institutions, but I'll give some general remarks concerning that very loaded question. The Bank of Uganda does not close a financial institution without going through the right process and without being sure that this is the only way out. And of late, the banks that have been closed because there was poor governance, directives were given that were not followed, there was high concentration of both either deposits or loans, which raised the risk status of that institution, and most importantly, the owners abdicated their role of ensuring that these institutions continue to run smoothly. And under such circumstances, if we went out and told the depositors we are going to close this institution because it has this problem, and this problem, there will be no money by midday of the next day for those who can access. And that means that all other processes will run into problems. That's why we can't come out to tell you that we are going to close a bank or we have started the process of, following up on this bank because we've seen this. But there are reports that come out. On our website, there's a lot of information that's there. If as an individual you're not capable to understand that information, but you put 5 billion in a bank, get your accountant, get a financial advisor and say, hey, pay that person 1 million shillings. After all, you have 5 billion. Tell them, read for me this report and tell me what you see. But I also accept that as BOU, we have a role. We have a role to do financial literacy, and these are some of the lessons we are taking out of some of these experiences. We've been doing financial literacy in other areas, but maybe we need to start also educating people on how to, assess the institutions they're involved in, or where they are putting their money.
Yes.
So that was the first.
You expressed it, you responded very well, and building on what Dr. Mumza had said. But I think the pain points are now the 10% share, not shareholders, but depositors above the 10 million mark. And sometimes their monies may be substantial, so they've had a substantial loss in the, like Mr. Mtevi said, in a delay. Or is there a chance that they may not get their money at all?
I want to reassure the depositors that have more than 10 million that they will get a payment. At this point, we can't comment whether they will get everything or they will get some of it, because ultimately it depends on what's going to be recovered. But let me also say that this is the first time in a long while that depositors who have more than 10 million are going to go through this. All the previous closures, with the exception of Greenland, the early ones, either a bank has been sold off to another bank or government has come out and guaranteed to pay the rest. So EFC, Crane Bank, depositors didn't lose their money. For Mercantile Credit Bank, unfortunately, government has not, for whatever reasons they have, agreed to bail out those who have more than 10 million. So our hands are tied. We have to go through the process as per the law.
I'll come back to the second question to you, Dr. Gesa. So, Dr. Mumza, so this may seem that it is more of a political decision to pay 10 million and less because there are many, but also above 10 million because they have bulk money, they can wait. Is that where it ends? Because Dr. Gesa says government has not come back to us, but Dr. Gesa is also government.
Well, government doesn't have to come in. As we said, the rules of the game were clear. We guarantee 10 million, and everybody knew it. Beyond 10 million is going to be subject to how much can we recover from this bank. And as I've said, if the governance and management of the bank was risky, they could easily have lent money to a general. Now, Director Gesa here and his team and whoever is going to help him on liquidating will depend on whether this general can actually pay back the bank the 200 million he took so that they can pay the depositors. So those are the complications now. Sometimes politics can come in and the president can say, pay them all their money. This happened, as I said, with Greenland Bank. I don't think we even had a deposit protection by then. I was going to lose the entire thing. But the president simply said pay them. And he had his own political reasons, because now the reasons for that cease to be derived from the banking sector practices and laws. The president will be looking at something else. But also he has first to see in the treasury, is that money there? What if now he gives it and we need some 600 billion to pay all for these people? Is it there? So there are many things that will come into that kind of space. I think within Cooperative Bank, they were compensated out of that political decision. So the political decision may be there, but the willingness is there, but is the ability to pay at that point in time there? As I've indicated to you, the government budget is possibly also constrained and strained up.
And just before you leave the microphone, because the bigger problem is, if you take Uganda economy right now, you have traders wishing to demonstrate over EFRIS. The management of government is saying, wait, you have a scheduled meeting with the president. And then traders, many of them will have more than 10 million in any one bank. So there's a big economy issue there as well.
Exactly, and who knows, maybe part of Mercantile Bank's challenge was the traders want to demonstrate and they couldn't sell, so they couldn't pay back the loans. You begin to see that it can be both ways. the effects can go to different directions. And I think that's what Egesa was trying to say, concentration of depositors. One of the things the central bank tests for is a bank must not have big depositors owning most of the deposits. Because if the bank has 100 billion in deposits, but it belongs to Mhums and Oscar, we can decide to go to another bank. Now that bank will automatically collapse. So they always check for that to say you seem to have a concentration of depositors. Same story with borrowers. You are not supposed to have few borrowers who are responsible for all their loans. What if they go under? So as he has indicated, the process is always moving on, and the central bank always advises, there is this risk here, can you address it? There is a risk here, can you address it? But those are internal things that they keep going on. So by the time they really act, time has passed, and both management, board, and maybe even the shareholders of the bank have not really responded. I think the main thing now is how do you keep the customers informed, the public informed, that when this information comes out, please take note. Don't go to a bank because it belongs to your clan, or because it belongs to your tribe. I keep hearing many Ugandans saying, we don't have local banks. No, I don't go to a bank because it is local. I go to a bank because it can give me the trust to keep my money. If its shareholders are shaky, it doesn't matter whether it belongs to my clan or tribe or country, I'll move on with a bank that I can trust. It's about trust.
Thank you. To Dr. Gesa is to have it less loaded, the question. So have you followed recommendations of the COSASE report of 2021?
The question seem more loaded than but let me we took the COSASE report very seriously, and we have recommended almost all the recommendations, but just highlight some of the key recommendations that came out which we have addressed. The first one was to adjust our resolution mechanism, to make sure that there are dedicated teams for resolution, to make sure that there are guidelines on how resolution should be done. I'm sure some of you had statements made that Bank of Uganda sold banks using phones. So we addressed all those comments to do with the resolution mechanism in the bank, and this is what's guiding the recent bank closure. So that has been implemented. There were issues to do with the amendment of the law, which are still pending because we don't have control on the process for amending the law. We have made our recommendations. The process is ongoing, but there are parts of that process that we don't have control over. But when that process is completed, I think that will tie up what's remaining. All the other issues that we needed to do internally have been addressed.
Thank you very much. Now we have an open session. I don't know if there are people here who would like to ask questions. You introduce yourself and ask a question or make a comment. Madam at the back, do you have a mobile microphone? Yes, please.
Thank you. I'm Petro from Kigo Thinkers. Thank you, Dr. Fred and Dr. Ken. My question is on corporate governance. I think it will be directed to Dr. Egesa. Or stewardship. Us who work in trenches downtown, we see bankers, the managers, whom we love to give our money, living flamboyant lives. Yes, children in international schools drive the latest SUVs and so on. And I'm sure, Dr. Ken, during your supervision, you have that early detection to know that this bank is going under because of the people who are superintending it. Now, in downtown, we say bazanyira mu sente zaffe. Simply, now, Dr. Egesa, do you ever punish those people because they are the ones leading us to ruin. And you can easily find out that this bank mainly has gone down because of the people on top. If you did, or if you are not, please do, because it will be a deterrent to the rest of the people who are in charge of our monies. Thank you.
Thank you very much, Petra. Yes, over here. And I think a media person, if you come and stand here so that captures you. You can't stand where he is. Yes.
Okay.
Stay where he is. Especially coming.
Dale was my name. I work for Capital and Beat FM. Mine is also related to hers. I'd love to know what measures in terms of monitoring and tracking these investors or directors, so that when a bank closes, they don't go again and open another new bank. Thank you.
And Dale didn't ask the real question he wanted to ask. There's a hand up over there, because I know he has 30 million in a bank. So I don't know whether it's Mercantile, but he should be looking at how to recover monies.
Thank you. My name is Eric Zachary Mgisha. I'm just a person from the internet. I want to pose a question both to Professor Fred and also Dr. Kenneth. In 2008, when we had the Great Recession, we remember the conversation coming around saying, what could the federal government have done to prevent the Lehman Brothers going down? And the question that rose was, if the central bank had intervened then, would it have saved the greater economy? The reason I'm asking this is, we know government currently is the biggest borrower for most of the commercial banks. So in the likelihood that, say, a bank like Stanbic goes down, just saying hypothetically, in the likelihood that a bank like Stanbic goes down, the ripple effects of that bank going down do not just take a depositor of 10 million, 30 million, a local depositor, but it also has an effect on government projects, government spending, even the loan that government keeps trying to repay. Because I know banks are very happy right now. They know government can ask for money and they will supply it. Government won't pay in time, but it will pay the interest on that loan. So in the likelihood that such a bank goes down, how do we see ourselves as Uganda operate? Thanks.
A good one. There's Ronnie here still has another question. And in between that, someone is saying, Sam in Kampala says, wow, Ugandan manufacturers may relocate to Tanzania to export back to Uganda. They have done it. Yeah. Can he stay there? You capture him? You got him?
Thank you, moderator. My question goes to Dr. Mpumuza. The issue of bank closure has ripple effect. If, customers cannot access their money, that means business opportunities lost, jobs lost, and so on. 2 closures in a period of, say, 1 year is a signal that something is...
A few months.
A few months. Is a signal that probably the supervision is not working properly. And we've seen that economies like China, there are some sectors of the economy that they have retained as a state to manage practices, to manage sustainability. Is it time for us to think about having the banking sector not entirely left to the market to determine everything that we are discussing here? Is it time to rethink some sectors of the economy, including the financial services sector, being retained by the state? Thank you.
Thank you. Philip wants to add on. Yeah? Oh, yeah, the microphone.
Thank you very much. I just want to put this in perspective based from my colleague here who are from the internet. Just again to put it from a practical point of view, as I said, I concentrate these days on practical economics. If you look at the effect of mercantile closure to the meat packers who are mainly one of their concentrated depositors, if these things are not rescued in time, it may affect somehow the livestock sector. As much as from the regulatory point of view, they may look at the concentration of the clients in a particular sector, but also you have to take in consideration the location and the risk management. For those of us who deal in the cattle and what, you are compelled maybe to have a bank account in the mercantile, because for meat packers you can access location, okay? And a number of, I think, I don't have the statistics of the curve, but I think a number of the clients in the mercantile banks were those people doing in the livestock related sectors. Thank you.
Thank you. And I dare say that's correct.
Thank you very much. My name is Aloysius Kasoma. I write for New Vision. My question goes to Director Mr. Igesa. I just want to understand, at all tiers, from tier 1 to tier 4, where have we attracted so many investors when it comes to banking? Because looking at the business line, the private sector deals more with tier 1 level circles and among others. So, but the risk looks to be at the level of tier 4. So where have we been able to attract more investors at all tiers? Thank you.
Dr. Igesa, do you want to respond now? And then we'll have Dr. Mumza and then some more questions.
Okay, thank you very much for those questions. Let me start with the first one on corporate governance. I think one thing we need to appreciate is that there have been many changes over time. The corporate governance rules 10 years ago have been impacted by some of these changes and have also been updated. So there are things that have come which were not key back then, like cyber risk and fraud, which is one of the biggest things now hitting the industry. So when something like that comes, you also have to adjust the requirements for corporate governance, the audit committees, the credit committees, the operational risk committees of the board. So we are also adjusting as some of these things happen to try and address those problems. But also to reassure you that for someone to become a member of a board or a key manager in any of these institutions, they have to come to Bank of Uganda to get approval. If they are involved in something that changes what we saw when we were agreeing them to come in, we ask them to, we make sure that they leave the sector and they can never come back to operate in the financial sector. So just to reassure you, that's the punishment. If a bank closes, to answer the question that was raised on whether we will allow them to go and operate again, the shareholders automatically are disqualified from participating in any financial institution regulated by BOU. It could be a forex, they could have owned a bank, but will not allow them even to run a forex bureau, as an example. Now, on the issue of Stanbic going down, God forbid, Stanbic Bank and 7 other banks
are classified as domestic systemically important banks. That means that these banks are large and interconnected with other financial institutions, that if they have a problem, the problem will hit the whole sector. Everyone in the sector will be affected. For these banks, we have additional regulatory requirements which don't apply to the other banks that are not classified as domestic systemically important banks. For instance, their capital requirements will be higher than the rest. They have to provide additional capital for reassurance. Our supervision is more intrusive of these institutions because obviously if it goes down, it's going down with a lot of people. So just to reassure you that for these banks, the domestic systemically important banks like Stanbic, we take even an extra leg to make sure that what we are seeing in the reports, what we are seeing on the ground speaks to each other, and that they are always well capitalized and provisioned as quickly as possible if there is any issue. So again, to assure you that at the central bank we are doing everything possible to make sure that these DSIBs are not impacted. And the last one was which tier attracts the most level of investments. I think maybe let's move away from the jargon of tier and say we have commercial banks, credit institutions, MDIs, and circles. Those are the 4 tiers, okay? Each of these kind of institution has its own business plan that fits within where it is. Otherwise, it will be failing or downgrading to a lower level. So all tiers or all institutions have their own type of investment. Some focus on corporate, some focus on small and medium enterprises, some target everybody. So it depends. I can't say a specific tier addresses one. And the last one on government participation in the financial sector. Government is participating. How? Postbank is owned by government. Housing finance is owned by government. Uganda Development Bank is owned by government. So government has not left the sector. Their pride also is there. So they are operating, maybe we can talk about the scale and maybe targeting specific sectors. Thank you.
Thank you. Thank you for that response. We have responses on X, formerly Twitter. Viewers and listeners can go there. Someone, Sharon Chwanuka, says, I've learned more about banking in 1 hour than any economics class I ever attended. So, this is a hand clap to the doctors here. Yeah. Then Evermore says, thank you for the information. I have always wondered what happens when one has more than 10 million in a bank account and the bank is closed. Charles Lwanga says, for how long? What if a bank fails to sell off the bank's assets? Can I get a share in their buildings? Dr.
Wondering which buildings and who, the buildings of Mercantile or the buildings of Bank of Uganda. Because those are government buildings. By being a citizen, you already have a share there. And you want to protect your share. Actually, sometimes it's very interesting to have these conversations. It might look like a weakness when 2 banks, okay, financial institutions, they call them banks, of course, are resolved within a very short time. But actually, for me, that gives me the strength to say if the central bank can do this, then it is actually a lot. For some of us who are alive during Museveni's days of transitioning, the other regimes coming in, you are on this hill and there are men with guns. And you are literally running away from the UNLA, the Uganda National Liberation Army, who have guns, because they are using them wrongly, to go to the NRA, who have guns, because you think those are using them rightly. And that was the truth at that time. So I want to take trust that the central bank and the regulator is strong enough to identify the weak ones and weed them out. Because one of the things the central bank and its core mandate is really stability of the entire financial sector, not just of one bank. So if one bank is going to threaten stability of the rest of the sector, like doctors do, they will cut off that leg. Because it has cancer that is going to go to the whole body. So you don't blame the doctor and say, but you cut off a leg. So are you a good person? No, he's actually good. So that should give us the trust that the regulator is active. And I always remind people, every bank that runs an advert will always end regulated by Bank of Uganda. They are giving you that trust to say, don't look at us, look at Bank of Uganda. And so when Bank of Uganda acts, that is one of the messages. The thing you really want to engage is what Katamba raised. If the central bank found 25 billion was too low, time had passed, is 10 million deposit protection not too low? And that's something we can engage. When did we set the 10 billion? 10 million, what was the criteria? Maybe to give trust to more people now, we may want to say, can we raise this to 50 million? What is the implication? Because you want to build that trust. For me, that lessons clearly are coming through. Should government own banks? He has already said the government is already in this space. But if government is borrowing from Stanbic to do its business, I'm even wondering whether government should own a bank. Because that bank will be a branch of Stanbic. Because they will borrow there to come and capitalize. And we've had that conversation. Because government is going to issue a bond which will be bought by Stanbic, and then they will go to invest in UDB. It brings you challenges. And then you are saying UDB must lend at 12%. But you mobilize this money from the banking sector at 17%. Meaning whoever is borrowing from UDB is being subsidized by me and you. And you want those policy conversations to come through. So what the central bank has done, and it does that very strongly, is to make sure much as government owns these banks, its influence that it used to have with the former UCB is not there. The board of the bank would take full responsibility. You cannot say the Minister of Finance sent us a borrower. You have a right to reject that borrower and leave to continue with your business. So protecting the governance of the government-owned institutions from government itself has been a very, very serious business. What you're seeing ministers interfering with agencies of government, I hear this is what, Honorable Kasaija cannot come and do that in the banking sector, courtesy of the central bank's strong hand. And there was a time when Bank of Uganda would only regulate. Now it is allowed to license. Licensing of banks was Ministry of Finance. Regulation was given to Bank of Uganda. Now they have the right to say, come in. If you don't operate like that, get out. And it doesn't matter whether you are a government bank or not, the central bank will chase you. That, for me, gives us the trust that I can leave my 10 million with a bank, including more, and as the more that we are saying, shouldn't we be having that conversation of raising, I think, that deposit minimum?
Thank you, thank you. Any other question, comment? Eric again. And it's okay to confess whether you are 10 million and below or 11 and above.
Thank you again. So this goes to Dr. Egesa. In recent months or recent years, we've seen the growth of e-commerce banks, and I do not mean the major banks, but I've seen a lot of platforms that come out to give people loans. We are a bit not sure of their regulation, but recent conversations around people, again within the fintech spaces, they say there's been delay from Bank of Uganda in okaying their licenses that would offer these banks that are maybe facing closure because of management and their asset value. So my question is, what is the lag between Bank of Uganda and approving most of these fintech aggregators that are supposed to make business for the commercial banks a little easy? And also, the other thing I think we have still in Uganda is the KYC detail with commercial banks and the central bank. We know currently most of the people have national IDs, meaning their records can be tracked with a NIN. If if that is the case, why can't I be able to open up a bank account, say with any bank, without the need to visit the bank? A few banks are doing it, but most of their banks keep citing that the regulation with them and Bank of Uganda does not allow them to do that, which, in my case, in my point of view, I think denies them a diverse audience of clients. Thank you.
Thank you, Eric. Today was not a day for KYC, and I intend to get Dr. Gesa on the KYC and URSB and filling in the same forms all the time, and the pain that is there. I'm collecting all this pain, and we shall have another session on that one. When they now call you to confirm, so it is. If you are running a business in Uganda and they all claim that it is Bank of Uganda, and you wonder why, but maybe you keep that one for when I'll get you in a hot seat for that one. But you could address his first one. In addition to what he's saying, do you feel you answered Petwa's question? Is there a mark where Bank of Uganda says your operations should stop, operation money and whatever, should stop at 20%, giving it some kind of context? And then when you hear, when you see all these robberies taking place, people moving with large amounts of cash, there was one of 120 million. Is this the trust we are talking about? So someone would move with their cash instead of leaving it in a commercial bank. I don't, yes.
Just again, in line with what Petra requested or asked, I think how are we, I think there is a big challenge as far as governance is concerned. And the only way I can quickly sum it up is by looking at two items. What we call the immediate owner. Who is the immediate owner of this financial institution, and who is the ultimate owner of a financial institution? Because most of these closures, based on my simple understanding, they are to do with related party transactions and inside dealing. But people are concealing this information, and they appear to be putting on a red shirt, but inside it is white. So I think that's another big problem. And then you touched on the regulatory framework. I still see we have a challenge which we really need to address immediately. The lag between the legal framework it takes to make the changes. Some of these things need to be taken immediately on. Are we going to have like special courts like the one we have for corruptions? We want to deal with specifically on the regulation regarding financial matters, because if it takes about an average, I think 7 or 8 years to change an act. I don't know how long it took us to change the Foreign Exchange Act in this aspect. And then by the time it is done and implemented up to now, I think we haven't even done the regulations. But the act has been here for some time, but we haven't done the regulations. So there's always a mismatch. And there's some of this mismatch, the people with bad intentions or with selfish intentions come and exploit this space.
Thank you. Dr. Muhumuza first, and then Dr. Gesa.
I thought they were for Gesa. But a few of them come to me. Well, KYC is really know your customer.
Yes. But I said that
for people out there. It will be out there. But it's critically important for the bank to know who that customer is and what else they do. And it's what he's saying about who is the ultimate owner. You also want to know who owns this account, what are they doing, and those kinds of things. But the challenge the banks will be facing, why they can't allow you to do it from your X and cyberspace, is because the systems are not integrated. By you sending your name, how do I confirm that this is actually your name? I would need to log into the NERA system, I would need to log into others to see your picture, but also get additional information that's not available. So ultimately, sometimes they need you to see you physically for that safety. Like now, I think one of the challenges that the Mercantile Bank and the Deposit Protection Fund has faced, who do you send this money to? Because people are using other people's mobile phones. So that is the mobile phone number they left with the bank. So you try to send money there, the name on the bank account is not matching the name on the mobile money because they are using their uncle's kind of number. Those are systemic issues, as we said, that are sitting out there, but also the issue of how fast can we change the laws. I know now we have actually a regulatory kind of challenge because when we set the minimum of which circles should be regulated under Bank of Uganda, we had said every circle above 500 million should transition from the microfinance regulatory authority to go to the ambits of Bank of Uganda. But that was 2008. 500 million was some substantial money. But now, so there are so many, and the law is still being debated on where should they fall. So when I have 2 billion, and Bank of Uganda says you are too small, you are just like a customer in a bank, I can't take you up. But then Umra is saying you are above me. So you want the laws to be proactively very, very frequent because the banking sector evolves quite very fast and things do change very fast. But I think the other part that we need here, and for me it is part of the discussion we are having, you find people emotionally saying, why don't we set up an agricultural bank? We have already seen that Mercantile had the bigger exposure to the livestock sector. So sometimes the things that Bank of Uganda will check on those exposures of one sector. You don't want when a sector gets a problem, the bank also feels that shock because the bulk of its customers were in that particular sector. And equally the other way around, that the entire sector is being supported by one bank. When that bank gets a problem, the entire sector gets a problem. So a number of policy discussions that we need to be bringing up here, which the central bank does at operational and strategic level, but they need to be having a conversation at wider policy level of government.
Thank you very much, Dr. Gesa. And you know, in your literacy posting that you promised you're going to start, will you also run adverts that say, don't keep money under your pillow, trust us?
I think let me clarify that although we have had 2 recent bank closures, the financial sector is still very stable. Actually, all banks are now meeting 150 billion capital requirements, and that's big. That means that chances of closing that bank because of capital issues have been more or less addressed. So please keep your money in banks, and we will do whatever we can to make sure that those whose deposits have not yet been paid, they get paid and shift them elsewhere. On e-commerce, I want to reassure viewers out there that we have very clear guidelines for entry. We have very clear requirements, and anyone who meets those requirements will be licensed. Someone telling you that Bank of Uganda is delaying their license is not giving you all of the information. It means that there are certain things they have not fulfilled. And we can't license until you fulfilled all the requirements. So I just want to pass on the message that if you want to access a certain product, a license for a certain product, make sure that your records and all the things you need to fulfill have been done. You will automatically be licensed. On the lag between regulation and passing regulation and implementation, I agree. Some of these take too long. Unfortunately, we have to follow the law, and until the law is amended, for us to remain transparent and accountable, we have to go through that process. So perhaps other agencies of government can do more to help us speed the process.
Thank you very much. We're in conclusion mode. If anyone has a question, comment to make before we invite our presenters to conclude, this is the time to do it. A lot of activity is going on online. I don't know, Eric, if there's any comment online. But it seems that there's a lot of traction on the lessons learned, and those about 10 million mark. A lot of this. Someone has whispered to me that switch on your microphone. So why had you not whispered to me to switch on my microphone? There's a lot of traction on social media on specifically two topics. The education taken from today, and that's a big applause to Kigo Thinkers, and then the others who are wondering what will happen to them. Dr. Gesa has given assurances. And as I was saying before, if we have any other comments, this is the time to have it. Otherwise, conclusions. Let's begin conclusion. Oh, Philip can make a comment.
One of my final comment on this. I am an advocate of public sector coordination to ensure that the citizens get value for their money. Where you can have public sector coordination, we've been talking about NIRA, we're talking about URBS, we're talking about URA, Bank of Uganda. Bank of Uganda cannot do the roles in timely manner. Why? All this is still in the public sector space. So there should be some very clear, deliberate efforts to have effective and efficient public sector coordination. Thank you.
Thank you. Dr. Egesa, conclusion. I should tell the audience, viewers, listeners, that television, radio, we work on time. The only other place you find people who work on time is with us, Dr. Muhumuza and Semwe Amsuke, because we work in education institutions. In school, the bell rings at the same time for lunch every day. Rings at the same time for supper every day. When you change that bell, you can cause chaos. So we are going to finish at midday.
Thank you, Oscar, for inviting the Bank of Uganda to participate in this. I think for me, the key takeaway is that we need, as Bank of Uganda, to do more financial literacy. This is something I'm taking back. We've been focusing on other areas of financial literacy, but I think this particular area of how to know your bank knows you because they do KYC, but do you know your bank? So I think this is something we'll take up strongly in the coming months. Thank you.
Thank you, Dr. Egesa. Also, sometimes teachers of English prompt that your final word, and for you borrowers that have a lot of money, you could. So, do you know those when we say finish that statement? Yeah.
Well, for those depositors that have more than 10 million Uganda shillings, I think you need to take more interest in knowing the institutions you're in, assuring yourself that maybe you need to distribute your risk. Probably, if you have 100 million, probably put in other banks some of that money. And we also take on board the comment that came through that perhaps it's time for the Deposit Protection Fund to start thinking about increasing this. But we feel the pain, and as I said, this is usually the last thing that we do, that's closing the bank, but we take on board all the lessons that have come through. And we continue learning as a learning institution.
Thank you. Dr. Mumza?
I think maybe two key messages. One is the close of bank should give you, sort of for those who have been affected, but it should give people confidence that the banking sector is safe. The central bank is doing what it's supposed to do. We parted with our own relatives. We put them into isolation because they have COVID. And if another one turns up with COVID, you also take them in isolation. That made the families safer, much as we have put away some of the people you love and you would want to see. So this should be interpreted as strength of the financial sector in Uganda. Keep your trust in there. But also don't just watch your bank. As I indicated earlier, your bank is part of the broader economic risks. Even those who have invested in banks that are strong have lost their own businesses for other reasons. So please be alert on what is happening in the economy, the sector you are in. You can be hit by anything. Don't just watch your bank, but also be sure how is your bank watching the economic environment. When you see that corner, don't just end up in the till to put or get the money out. Sometimes it takes good to talk to the bank manager. What do you see in the economy? Because remember, they see a lot within that economy. So when you get to the bank, it's not just about the transaction.
The bank manager will tell you?
The bank manager can give you idea on what is happening in a specific sector. Many times we just submit a loan, I want to borrow and do poultry, but you haven't asked them what do you see in the poultry sector. Because remember, your success is their success. So some of these bank managers will actually alert you and have a conversation with you that we see these challenges coming up in the school system. You are in the school business. How have you prepared for them? Drive them into that conversation. A good banker should have that relationship with the borrowers. If they don't, they too are carrying the risk. So please extend banks and make them your sources of information for many other things that you do in your life. Thank you.
Thank you very much, Dr. Mumza. We also want to thank sponsors of Kigo Thinkers. This hotel, Golden Tulip, one of the sponsors. The media stations, Capital Radio, one of the sponsors. We should give them a hand clap, as I mentioned. Bouquet de TV, one of the sponsors. BBS, one of the sponsors. NTV, one of the sponsors. We thank you very much. Thank you once again, Dr. Egesa, Dr. Mumza, and everyone who has said something at this event, at this Baraza. We thank you very much. I am Oscar Semweyamsoke. You can follow us at Kigo Thinkers. There's a dash somewhere there on X, and at Semweyamsoke. Thank you so much, and we shall invite you again. Thank you.